Okay. What you need to know about the Nigerian Tax Act 2025. Three main objectives that I want you to go away with from this session. The first one is I want you to understand what has changed under the 2025 tax framework. Second objective is I want you to identify which taxes apply to you or your business category. And the third is I want you to leave this session with actionable plans, next steps, what you're going to be doing better before the enforcement begins in January 2026. So those are the three things I want you to understand. Let's look at the current tax regime and what is going to change from 2026. The first thing is currently we have multiple taxes that are administered by separate government bodies. So we have FIRS. FIRS is Federal Inland Revenue Service. We also have state IRS and local government administrations. So you will see that currently all these bodies collect different taxes. So there is a lot of multiple taxes. You realize that some people you will pay the same tax like 3 or 4 times because different bodies are coming for tax and you don't even understand what the tax is for and all of those things. What they are seeking to do with the 2026 implementation is to unify all taxes within the country. So you see unified digital tax reporting for individuals and businesses. It's also so good that you don't even have to leave the comfort of your homes to pay your taxes. You can simply, I'll show you where you can pay your taxes, how you can do it, what you need to do to pay your tax in the course of this presentation. So there is a unified digital tax system that now exists that will be implemented from next year. The second point is high non-compliance due to complex filing processes and low enforcement capacity. What I've found is that a lot of Nigerians want to do well. They want to pay tax. But the challenge is there is no clear cut, direction on how to do this. Some people are sincerely confused. I run a business. I want my business to be compliant because now if you don't even pay taxes and you don't have tax clearance, there are some contracts that you cannot undertake, that you cannot get. They'll be asking you for your tax clearance certificate and all of those things. I want to be able to bid for those top contracts with big companies. And big companies will ask me for my tax documentation. For that reason alone, I want to be compliant. But it is not clear. I don't know where to go to. I don't know how to do it. I don't want to talk to anybody. I just want to do my thing by myself. And I don't also have capacity to hire a tax consultant or an accountant to do that for me. So that's the complexity that currently exists within the current Nigerian tax framework. That's why the government has said that from next year, let's make it clear to people. Let's make it as simple as possible so that everyone can file their own tax returns by themselves. The next thing that we currently see is many digital earners and SMEs operating outside the formal tax nets. The reality is, in Nigeria currently, less than 20% of the population actually pay tax. A lot of people don't pay tax, right? Whether remote workers, people in the informal sector, the market woman that is trading in my 12 market or Wuse market or the Katangwa market, those people don't even understand what taxes. They don't even pay taxes. What they do largely is to pay local government rates. And, Agbero will come, market people will come and just collect daily rates from them or weekly rates from them. They don't understand what they are even doing. So what the current tax framework is proposing is there is a lot of greater integration between banks, payment systems, processors, and FIRS systems. And I will show you all of this in the course of this class as well. Frequent policy changes without clear implementation timelines, which is now causing a lot of confusion. What we're going to see going forward is automated withholding and deductions model to reduce manual filing. You don't need to do manual filing again. Someone has asked in one of the questions, one of the most frequently asked questions, that will government be deducting money directly from my account? I will say no. There is no, I don't think they will deduct money directly from your account. Nonetheless, there is already a system in place to monitor every inflow that comes into your account. As far as you have BVN, you have NIN, you have a Nigerian account, government, these relevant agencies, the stats relevant agencies can see the inflows into your account. I will tell you how to deal with that in the course of this presentation. What are some of these key tax authorities that you need to know and their roles from 2026? Their roles now and how their roles would evolve in 2026. The first one is Federal Inland Revenue Service, FIRS. FIRS currently handles company income tax, VAT, which is value added tax, digital tax, crypto earnings. What is new about FIRS? What will they be doing from next year? Digital compliance portals, data syncing with banks, fintechs, and they'll also be using AI-driven taxpayer monitoring. We have the state IRS as well that will be managing or that currently manages personal income tax for and informal sectors levy. What will they be doing new from next year? They'll be tracking freelancers' income, influencers, online vendors using NIN, BVN links, inflow data. I already mentioned that earlier. Local governments. We also have local government that would come to you at one point or the other to collect taxes. But what kind of tax do local governments collect? It's simply rates, right? Rates and permits, especially for those who own physical stores, right? So they collect market and shop levies and informal taxes. What is new about local government authorities from 2026? They will also be using a lot of digital ticketing and coordinated data sharing to curb double taxation. And the last body you need to know about is the Joint Tax Board. The Joint Tax Board harmonizes taxpayers' record nationwide. What is new about these guys? What will we be doing? That they are more like an infrastructure, a framework that supports the entire tax system. What would they be? If you think about the Joint Tax Board as the CBN, as CBN is to all the banks in Nigeria, Joint Tax Board is that framework that supports the work that FIRS, state IRS, and local government authority actually do. So it is their purview or is their responsibility to now create a unified tax identity linked to your TIN, tax identification number, NIN, which is your national identity number, and your BVN, which is your bank verification number, and digital wallet. So let's get into specific details of Nigerian Tax Act of 2025. What are some of the taxes? This is not all the taxes. I just identify some that I believe applies to small business owners and the people that I envisage will be in this class. So these are the taxes that would apply to you based on the business category that you have. The first type of tax is company income tax. Note the word company income tax. Within the confines of the law, if your business is registered as a business name like enterprise or venture, you are not a company. A company is any company, if I can use that tautology, that is registered as a limited liability company. So if your company is currently registered as a limited liability company in Nigeria, from next year, you are liable to pay company income tax if there are conditions. Number one of such condition is if your business makes more than 100 million every year in turnover. Another word for turnover is sales. So let's say what you sell is human hair, and you are registered as Sharon Limited. At the end of the year, if you make 101 million total sales, how will they track it? How will they know that you have made 101 million sales? All the money that has entered your business account for the year, if it sums up to 100 million and one, and you know that it's not limited to one account. Let's say you have 5 different accounts, 5 different business accounts. 20 million enters account 1, 30 million enters account 2 for the year. If they lump it together, through your BVN and they see that you have made 100 million and above, at the end of the year, you will be required to pay company income tax of 20%. If it is more than 100 million but less than 500 million, you'll be required to pay 20% within the confines of the law, the tax law. If your business makes less than 100 million, 25 million, 30 million, 40 million, 50 million, and that less than 100 million, you are classified as a small business. Know that word that we use, small, medium enterprises, SME, is actually a classification of different businesses. S stands for small business. Within the confine of the tax law, if you earn or make less than 100 million in a year, you are called a small business. And your company income tax will be 0%. You won't pay any tax. If it is 100 million and 5 naira to 500 million, you are classified as a medium business. You know, we're saying small, medium enterprise. Medium. You are a medium business if you make, well, they classify small business 0 to 100 million, you won't pay tax. Medium business 100 million to 500 million, you will pay tax of 20%. Then large business or corporations are businesses that make 500 million and above. So for businesses that make 500 million and above, you will pay 30% tax. 30% tax, you are not paying tax on your revenue. You are paying tax on your net profit. So I would explain that in detail in the course of this class as well. What is the exemption? You can see under the exemption, 0% for LLCs with less than 100 million per annum in turnover. The next type of tax is personal income tax. Who are those required to pay personal income tax? From the word personal income, the money that comes to you personally. So there are two sets of people that are required to pay personal income. If you own a sole trader business, meaning that you own a sole proprietorship business, your business is registered as a business name. You know, I said if your business is registered as a business name, you will not pay company income tax. But it is only company income tax that you will not pay. There are still other type of taxes that you'll be required to pay. One of them is personal income tax. So if you're a freelancer, a consultant, someone who works remotely, these are the type of tax that you pay because you work for yourself. If you work for a corporate organization, you work within the corporate, you have a 9 to 5. When those ones are pretty much easy. Before your salary enters your account, your employer would have deducted what they call pay as you earn, a percentage. And that percentage is from 0 to 25%. I will show you how that works in the next slide. 0 to 25% is what they deduct. And if your salary is less than 800,000 per annum, you are also exempt from tax, meaning that those are people who earn minimum wage, right? So 800,000 per annum will give you around 77,000 per month. So if you earn 77,000 per month, you will not pay personal income tax, right? If you're a remote worker, a freelancer, or a sole proprietor, you would be required to pay personal income tax because why? Your company, the business name that you have registered, and you are seen as one and the same. The income of that business is your income as far as the tax law is concerned. If you have registered a personal income, if you have registered a sole trader, I will get into why you should pick LLCs over sole trader or sole proprietorship. I'll get into that. The next one is VAT. The good thing with VAT is you are not the one paying the VAT. You are only an agent of the government to collect VAT from your customers. The rate is 7.5. Example, you run hairdressing salon. In your salon, you charge per customer, maybe you charge like 50K to make hair. When you are charging the 50K, you have to put it on your invoice. The implication right now is in the regime of just collecting money without invoice or documentation is going to an end. That's why I want you guys to see it as this is an opportunity for me to do things right in my business, run my business right, get my records proper, so that when investment opportunity comes, I can simply produce my record to the investor and they can see that I run a proper business. So you invoice the customer 50,000, which is the cost of your service, 50,000 for the air. But the customer will not pay 50,000. You will now say plus 7.5%. You find what is 7.5% of 50,000. Let's say that is 7.5. Just saying, could be more than that. The total the customer will pay is 57,500. That's what you collect from the customer. So all the customer that walks into your business, you do that for them. At the end of the month, you lump together. So what I would advise small business owner like on this call that want to start charging VAT and you don't want to spend, because if you spend government money, is an offense. So what I always advise them is, can you also open another account? You call it VAT account. So immediately you are collecting all those 7.5, you are just transferring to that account. And at the end of the month, you have up until 21st of the subsequent month. So let's say that this is October. All the VAT that I collect from October 1st to October 31st, I have up until November 21st to remit to FIRS. FIRS is the agent of government that collects VAT. So you have up until 21st of the subsequent month to remit all the money to them, right? But there's also exemption for VAT. If your company is a small business with less than 25 million per annum turnover, you are not required to collect tax, to collect VAT, right? Another exemption is there are some industries or some businesses that are naturally exempt from tax. Example, if you sell basic food items, like if you go to supermarkets and you buy things off the shelf, you buy rice, staples, literally, they are not expected to charge you VAT for that, right? If you go to open market and you go and buy tomatoes, one basket of tomato, 15,000 naira, they can't say 15,000 plus VAT. Food items are exempted from VAT. Another type of tax that is exempted is education. If you own a school here, you cannot put VAT on school fees. Tuition is exempt from tax. Another one is health. If you go to a pharmacy and you buy drugs, or you are a pharmacist, or you own a pharmaceutical company, you are not supposed to charge VAT from people that come to buy drugs from you, right? Those are exempt from tax. The next category of tax is capital gain tax, or CGT. And this affects investors and traders, especially crypto traders. And this is one of the ones that they want to really start enforcing as well. 10% capital. What is capital gain tax? It is the tax that you make. It is the tax on the profit that you make on the sale of an asset. So let's say I have crypto and I sell my crypto, right? I sell part of those assets. The profit that I make from it is subject to 10% capital gain tax, not the amount that I sell it for. So let's say my crypto is 10,000 naira and I sell it for 15,000. The cost of the asset is 10,000. The selling price is 15,000. The difference is 5,000. That's the profit. I will now pay 10% of 5,000, which is 500. That will be my capital gain tax that I have to pay. Then the last type of tax, for the purpose of this discussion, is withholding tax. This is peculiar to contractors, right? So you will see that when you work for large companies, they don't pay you your full money. If I'm offering my professional service to a company right now and I'm charging 1 million, let's assume that that's my professional fee. The company by law is required to deduct 5% as withholding tax from it. Withholding tax operates like VAT. In that mix, in a withholding tax mix, the company deducting the money is also acting as an agent of the government. Just the way you help the government to collect VAT, companies also help the government to collect withholding tax from people that have worked for them. So all the professionals that work for them, they charge 5%. I'm an independent contractor, meaning that I don't have a full-time employment with the company. If I have a full-time employment, then what I pay is personal income tax or payee. But now that I'm a contractor to the company wants to pay me 1 million professional fees. They are required by law to deduct 5%. 5% of 1 million is 50,000. So they will now pay me 950. They pay me 950,000 and give me a withholding tax certificate or something that shows that they've deducted that money. What is the utility of that certificate that they have given me? At the end of the year, when I want to file my own personal income tax, I will now bring all the certificate. Let's assume that in that year, I've worked for 500, no, 500 is too much. Let's assume for that year, I've worked for 50 companies, 1 million each, 50 million. All of them deducted for 5% from my money. So 5% of 50 million is 2.5 million. 2.5 million is what all these companies have deducted, different companies, but each of those companies gave me a note, what is called withholding tax certificates, to show that they deducted the money from my income, from the payment they were supposed to make to me. My duty when I'm filing my tax at the end of the year, I will now gather all those documents, all those receipts that those guys have given me. I will now take it to the relevant tax authority. Let's assume that they are now assessing me for the year. I'm supposed to pay 25% of my income as tax for that year. If 25% of that my income is like 10 million assumption, that's what I'm supposed to pay. They will now remove the withholding tax that those people have collected in advance. So that's why I put it under the note. Withholding tax is not final tax. It's an advanced tax payment. Why do they charge withholding tax? It's on the assumption that government doesn't want you to run away with all the money. It's like a risk management strategy. Government wants to ensure that you don't run away with all the money or you don't hide some of your income. It's more like a means to an end, because that company as well that's collected the withholding tax will now be required to remit it to the government. So those are the taxes. There are still more taxes that are not covered on this slide. I've just picked some that I believe that would apply to majority of people that will be on the call. So let's look at computation of personal income tax. How do they compute personal income tax? The tax administration currently, what they are proposing is a progressive tax system where we get more money from the rich people and will, like I said, we allow the poor breathe. So this is the percentage. If you earn 800,000 and below per annum, you will not pay tax, 0%. If you earn 800,000 to 3 million, 15%. If you earn 3 million to 12 million, and the way this is done really is not straightforward as I've made it like this. So what they do is, let's say you earn 10 million per annum. So how will 10 million be taxed based on this scale? They will first take out of this your 10 million, the first 800,000 is tax-free. You won't pay tax on that. The next 3 million of that, your 10 million, they will tax that as 15%. The next, whatever is remaining after 3 million, because it can be 3.3 plus 800, that's 3.8. Whatever that is, they will now tax that at 18%. Whatever they get is what you pay as tax from your income. So this is how to compute it. 0% for first 800, 15% for 800 to 3 million, 18% for the next 3 million and 1 to 12 million, 21% for the next 12 million and 1 to 25 million, 23% for the next 25 million to 50 million, and anything above 50 million is now taxed at 25%. So what counts? Let's talk specifically on capital gain tax, because I believe that this is one of the most confusing and conflicting type of tax that a lot of people have raised objection on. What qualifies as a realization event? Realization event means that what is taxable within the capital gain tax framework. A taxable CGT event occurs when an individual or company sells crypto or digital assets for cash, naira or foreign currency. So if you log into your crypto account and you sell your crypto, whatever you realize, the money that you realize is qualifies as a realization event. Another one is if you swap one asset for another, meaning that you swap like BTC, Bitcoin for Ethereum, that's also a realization event. If you use your crypto or digital asset to pay for goods or services, that's a realization event, a realization event as well. If you transfer asset as gifts or to related parties, unless it's to a spouse or for inheritance. If you transfer asset as gifts to someone else, that person that is getting that gift is supposed to pay tax on it. Tax is, especially within the crypto, now I'm talking about the crypto space, right? Except it is to your spouse or you're transferring to someone as an inheritance, right? The next one is when you convert tokens into equity during fundraising. Token sales, depending on structure, are all now subject to FIRS review. Simply holding, so now this is something to allay your worries, just to make you calm down. Simply holding or stacking crypto without disposal is not a taxable event. If I'm just investing in crypto, nobody's going to tax you for that. It's not a taxable event. So how do you file your CGT? How? The first set of people, individuals, you must file CGT. Don't forget what I said, CGT, capital gain tax, 10%. Returns within 30 days of disposal. If you sell your assets today, within 30 days of sale, you should pay tax on the gain that you have made on it. For companies, you must include CGT on digital assets in your annual tax computation because companies pay tax usually once a year. So if you run a company here, it's not that you're going to pay tax every month. Your company income tax is only paid at the end of the year. I will show you some of the tax, but based on what I've mentioned earlier, personal income tax has to be paid monthly, and also VAT or WHT, withholding tax, those are paid monthly. And of course, for exchanges, you may be appointed as collection agent when transactions pass through regulated platforms or payment gateways. So I want to talk about some of the questions that I've seen people ask where this tax is concerned. One of such questions is, how will they know my income? How will they know my income? This is the way they will know your income. Bank triggered tax compliance monitoring. So there's something right now that is done that monitors the flow of money into everyone's account. So let's assume that you've not paid any tax to FIRS or the state IRS for 5 months, and they are seeing that there's a pattern. That's the funny thing with AI. AI can monitor patterns, right? Patterns meaning that they see that between 20th and 25th of every month, you receive inflow, right? AI would flag it, and they know that usually between 20th and 30th, most people get paid their salaries within those days. So if you now have a pattern where every month between those 10 days, you get a lot of a certain range of amount, can be, let's say you get a certain range of amount from like 1 million to 2 million, and it comes at that time, and AI quickly checks the tax record. Now there's an integrated system between banks and relevant tax authority, state IRS and FIRS, federal IRS, right? There's an integrated system that checks. Let's say my name is Shay. Of course, my name is Shay. And I've not paid tax for like 5 months, January to May, to FIRS, to state IRS. And AI is monitoring to see that every month I receive money within those dates. It quickly goes to check FIRS and FIRS database for my name to see that if any amount has entered FIRS for my name. If it hasn't, it goes to state IRS platform and monitors it, that as this guy's name reflected in any of this, your tax system, if my name has not reflected, bank triggered. So that's the explanation for that of that first point. Bank triggered tax compliance monitoring. It automatically flags my name and says something is wrong. Check out this guy, and then that would now make them to come and check. Maybe send me a letter request for my proper statement of account for me to explain why is money coming into my account consistently for 5 months and I have not rendered any return to the relevant tax authority. The next one, banks now report unusual or high value inflows directly to tax authorities. Yeah, that is already explained. If cash inflow does not match declared income, the tax system can automatically prompt an audit or demand clarification, right? So like I said, I earn 1 million every month. That is the money that flows into my account. That's what the AI has discovered as the pattern of the revenue, of the money flowing to my account. Ideally, personal income tax, based on what I've shown you guys, should be around 18%. And they see that what I'm paying as tax is like 2% of the money that I'm really making every month. So this database, this AI tool also checks all of these irregularities and sometimes may flag your account or flag your name, and they will say they want to come and do tax audits. Tax audit is when they will now ask for your record, the tax you are filing and the income you are making, and actually individual will come maybe to your place of business, or they will invite you to their office or something where they will now do that. Unregistered businesses receiving consistent inflows may be flagged. So another thing, let's say I have an unregistered business, but I'm receiving inflows into my personal account, right? It's also a license for me. They can actually use that as an opportunity to quickly auto enroll me and charge me whatever they feel is right based on the inflows and outflows that is coming from my account. Now, someone that wants to do right, what are some of the documentation that I need to have, that you need to have for you to stay compliant where January 2026 is concerned? The first thing is tax identification number. So you need to apply for TIN, registration certificate. The next one is you need to start learning how to prepare basic income statements. If you cannot hire an accountant, there are several apps that allows you, that is very easy, that you can use to present your record. And it's as simple as you just download the app. Every day as you are incurring this expense, income is coming, you just type it, you just put it there. My income, I just sold something. You record all your sales, you record all your expenses. At the end of the month, that's all these apps like QuickBooks, there's one that's called Contents. They can help you generate simple financial statements or simple income summary that you can submit when you are rendering your tax return. Another one is invoices. If you don't have a platform that you use to issue invoices to your customers, it is high time you did that. So get platforms that allow you to issue invoices and your bank receipts. Of course, your bank statement, that is, perhaps you are also on this call, you don't have a registered bank account for your business. It's high time you did that as well. So you need a bank statement when you want to file your return. In filing your return, you have to show them. So you have submitted your bank statement and that income report that I mentioned. So your income report there must be a correlation between your income and expenses that you have recorded and your bank statement, what your bank is saying as the money that entered your account and the one that left your account. So there must be a sync in those two reports. Next one is proof of VAT collection and remittance. This is not for everybody. So if your business does not make up to 25 million, like I said, you don't need to collect VAT. If your business falls under food, not restaurants. Restaurants collect VAT. I'm talking about people that sell basic food. The way you understand it within the Nigerian language is to say raw food. People that sell raw food, like raw rice, and all of those people, it affects those ones. Then another thing you need to know, failure to file within stipulated deadlines automatically triggers penalties and interest, which may now be issued digitally rather than through physical notices. For some of us that live in Lagos or Abuja, I don't know whether it's common in Abuja, but I know it's common in Lagos. You'll be driving your car and you just get an email, like a text message, that you violated a traffic offense. Nobody is sending anybody any physical document these days. They'll just send you a text message on your number, on your phone, and you now open the phone. Once you open your text message, it gives you a link. You can go to that link and see your offense. How did I know this? Because it has affected me once or twice when I was in Lagos. I think my vehicle license expired and I didn't renew it. I've not had time to go and renew it. I now found out that they have all these cameras installed. The camera just picks up your plate number. All these things are AI. It sees they have your details already, your phone number, your email address, and everything, and it triggers it and sends you that message and says that this is the fine you have to pay. Think 20K fine then, and you have up until so date before they will now start enforcement. So if you don't pay it before those days, before the days that they've told you to pay it, they can come to your well, they don't really do that, but they can actually come to your place of physical business and seal it up or enforce it. So it's high time that we did all of these things right. So those are the documentation that you need. Now let's talk about for a sole trader. You are someone who has a business name, which I believe a lot of people have business names right now. What is the hack? How can you better manage your tax system? Step one is you need to register. Let me backtrack a little. For someone that is not even registered at all, you have a business that is not registered at all. What is the first step for you? You have to register your business name or company with Corporate Affairs Commission. When you are done that, the next step is to register for TIN with FIRS or SIRS. For people who have LLCs, you need to understand company income tax is collected by federal government. Personal income tax is collected by state government. So it is the state government that you live in, the state that you live in, the government of that state is the one responsible for collecting your personal income tax. So if you live in Lagos, you pay your personal income tax to LIRS, Lagos Internal Revenue. If you live in Ogun State, Ogun Internal Revenue. If you live in Abuja, Federal Capital Territory, FCT, IRS. Those are the people that you pay your tax to. The next stage is for you to open a bank account. Then fourth is tax registration. So after you've gotten TIN doesn't mean you have registered for tax. You still need to now register as a taxpayer. I'm talking about the steps that you need to take now before 2026. If you have not done it before, you need to do all of these things. For some of you, already registered your business name. You have crossed that hurdle. For some of you, you already have a bank account, because when you wanted to open a bank account, they asked you for TIN. You didn't know what it is, but you just quickly went and opened it, or you got someone to help you do the TIN. So you sort of have 1, 2, 3 figured out. But the fourth, some people may not have done it before, is to actually register for tax. So now you now need to clarify. I'm a company, I have a LLC. My company currently makes 100 million and above, or even if it doesn't make 100 million and above, you still need to register for tax, because there's something called zero tax. You still need to file, you can still file zero tax, meaning that I have an exemption, but this is still my record. I'm not paying anything. It just shows that you are compliant. In other words, everyone still has to submit their records to the government or to the relevant tax authority at the end of every month or year, depending on the type of tax that we're talking about. Tax registration, you have to register for tax. Then the next one I mentioned, VAT registration. If you're someone that, if you know that you run a business that falls into the category that is supposed to collect VAT, you have to register for VAT separately. If you fall into a business that collects withholding tax, which means that withholding tax is more of companies that work with a lot of freelancers. You have a company that, there's a particular lady that has this, I've forgotten her name now, she's quite popular on social media, that has this business that hires freelancers, right? If you have business that hires freelancers, you as an employer, or you give job to people, you as an employer need to go and register for withholding tax. And as those people are getting paid their consulting fee, you deduct 5% from it. And the summation of those 5%, when you want to submit your tax return, you sum it up and pay it into the relevant government pocket. The next one that everyone has to do is payee registration, pay as you earn, because everyone who is employed that works must pay pay as you earn. And the last slide, or the last step, is you activate on FIRS Tax Pro Max. So this is the platform that FIRS uses for tax. I said that you don't have to go physically again. You can do everything from the comfort of your home. Just activate your account. And I will send this slide to all of us at the end of the presentation as well, so you can have it as a reference document. So that's the final step. You register, you activate your account. After you have opened the account, you have to activate it, right? Activate. And all these, opening these accounts are actually free. You don't have to pay any money until you want to start paying tax from January, right? And you get the compliance certificate. So let's look at another question. When would I be required to file tax? When we use the word file in tax discussion, we're talking about pay. When are you required to pay the tax? The first type of tax that we looked at is company income tax. When is the deadline for company income tax? 6 months after financial year end, or 18 months after incorporation, whichever comes first. So 6 months after financial year end. So let's say that January to December is your financial year end. You have up until June next year to pay your company income tax. If you file late, there are penalties. 25,000 for the first month and 5,000 for each additional month. Payee is pay as you earn. When should you pay as you earn? Monthly, usually by the 10th of the following month. Because payee or personal income tax is paid to the state government, the state government agency. Most states would have different rules around the deadline. But for Lagos and Abuja, I think you have to pay it on the 10th of the following month, maximum. So meaning that, let's say you have 5 employees that are supposed to deduct tax from their money, from their salaries, and pay all the money that you have deducted maximum before 10th of the following month. You deducted money for October. By November 10th, you must have paid the money to the authority. Employers must remit deducted tax to IRS. Then the next type of tax, VAT, monthly as well. You file VAT monthly on or before 21st of the following month. You see the caveat here. Even if you made no sales, you must still file new return. So let's say for the month, you didn't make any sales. Does that mean you will not file returns? No, you will file new returns. You will say you didn't sell anything. You will file it. And when you are saying you didn't sell anything, your bank statement must also echo the same thing. Your bank statement must not be saying something different, right? So how do you cross that hurdle? I think I will get into that. Let me not get ahead of myself. I'll get into that. How do we cross all these hurdles? Then the next one is capital gain tax. 30 days after a chargeable transaction occurs. Applies when you sell assets, shares, crypto, property, etc. So if you sell a property today in Nigeria, your father gave you a property and you sell the property, whatever you make, whatever the capital gain tax of that property is. So what they will normally do is, what is the market value and what is the cost price of that property? Whatever the difference is, you pay tax on it, which is also 10%. And of course, withholding tax, 21st of the following month, just like VAT, and personal income tax before March 31st each year. Personal income tax is also paid once a year. Now, to the main point, how can I legally, after you have known the type of tax that you are supposed to pay and all of those things, how can you legally reduce your tax liability? Right? There are ways that the law allows for you to reduce your tax liabilities. You just need to know them. So these are the three categories of people I've been talking about since. I've talked about individuals, people who work in corporates, 9 to 5 people. And I've talked about sole traders and people who own limited liability companies. Let's talk about the employees first. One of the ways that you can reduce your tax liability is through voluntary pension. You can increase your contribution to pension. Usually, if you check your pay slip, if you work for a company, that compliant company, not a company that does not comply, you will see that there's already some statutory deductions from your pay. Statutory deductions are the ones that are compulsory deduction. A certain percentage of your salary is already being deducted as pension. They deduct it from your account and pay it into a pension account that is also for you. So Nigerian pension law currently is contributory in nature, contributory, meaning that you contribute a portion, your employer contributes another portion. I think it's like 15% now, 15%. So your employer can choose to contribute 10% while you contribute 5%. The employer can also choose to contribute 7.5% and deduct 7.5% from your salary, depending on how the law allows the employer a certain measure of flexibility for that. So let's assume that your salary is 500,000 naira. That's what you take home every month from your employer after they deducted your pension and other statutory expenses. It's 500,000 that is left. But the 500,000, you saw that they used to remove like 100,000 naira tax before that 500,000 gets to you. You know, say, this 100,000 I'm paying as tax is too much. Can I reduce it? Yes, you can reduce it. How would you reduce it? You reduce it by contributing some of your salary to voluntary pension. You can simply tell your HR that deducts 100,000 from my salary before it comes to me and pay it into my pension account in addition to what I'm already paying under statutory. So you pay 100,000 into your voluntary pension. The law allows you to remove 100,000 from your salary first before tax is now applied on the balance. That is one way. The other way is to take up a life insurance policy. If you take up a life insurance policy, the law allows you to also deduct that. Another exemption that payee people enjoy is what is called rent relief, which the new tax law introduces. You can deduct up to 20% of your annual rent or 500K, whichever one is the first. So let's assume that you live in an apartment where you pay 1 million per annum. 1 million per annum. 20% of that 1 million is 200,000. The law allows you to deduct that 200,000 per annum as rent relief. If you live in a place where you pay 5 million per annum, 20% of that is supposed to be 1 million, but the law says you can only deduct 20% or maximum of 500K. In that second example, your rent relief is only 500,000. And the last exemption that people who have paid employment can get access to is termination benefit. Let's assume that your employer terminates your employment today. The law says that if your termination benefit is up to 50 million naira maximum, you will take all the money tax-free. They won't tax it. But anything above 50 million will be taxed. Anything below 50 million is not taxed. Let's talk about sole trader. The second set of people are sole trader or sole proprietors. What are the options you have to reduce your own tax liability? Voluntary pension, same way individuals can do. You can open a pension account and start to pay pension for yourself. You can also do life insurance. The other one, which I believe is the best formula, is for you to register as a limited liability company. If you currently have a business name, don't forget, I said if you have a business name, what you are being taxed on is the whole of your business income. What do I mean by that? Let's assume that you have a business name registration, and at the end of the year, you make a total of 200 million. That's your total sales for the year, 200 million naira, and you have a business name registration. How much would you pay as tax? First off, the law allows you to remove business-related expenses, all the expenses that you incurred to make that money that is related to that business, not the cost of things that is not related to the business. And that's why they will ask for your statement of account and they will check all the line items in your statement. Let's say that you have a shop in Eko. That's not where you live. You have a shop. The rent of that shop is 10 million. The law allows you to remove 10 million from it because you have a shop that is separate from where you live. I would also use this example for people who work remotely. So and within the year, let's say you bought some things for the business, you paid for marketing, you paid for this, you paid for that. Everything you paid that is related to the business, I'll just put those as other expenses. Let's just put those as other expenses. Other expenses came to like 70 million for the year. Don't forget, we are doing for the year. So that's 80 million. Rent 10 million, other expenses 70 million. 70, that's 80. 80 minus 200. You have 120 million left as your profit. What is the tax you now pay? You now pay tax on the whole of this 120 million, 25%. Assumption. It will not be up to 25%. By the time they, don't forget, they will do first 800,000, zero, next 3 million, just like I've shown you in that. But for the purpose of discussion, let's say 25%. You are now paying 25% of 120 million. Someone should help me. What is 25% of 120 million? Put it in the comments. Put it in the chat box. Someone should just do the calculation. 25% of 120 million, meaning just divide 120 million divided by 4. What is that? I want to see whether you guys are following me. Can you guys hear me?
Yes, sir, we can hear you.
Excellent, thank you. So you can see that in that mix, your tax is now 30 million. A whole 30 million to the government. You can see how painful it is, right? But if you registered as a limited liability company, what benefit do you stand to gain? Same example, you made 200 million for the year. Same example, and your rent and everything, your expenses came to 120 million. Your profit came to 120 million. And from company income tax, we said that any company that makes, whose revenue is less than 100 million will not pay tax. But if it's between 100 million to 500 million, you pay 20% as company income tax. So now the 120 million, you are treating it, you treated the 120 million as your company income. It is not your income. So you are treating, but from that company, you pay yourself a salary every month. Let's say you pay yourself a salary of 500,000 every month, right? 500,000 every month. From that 500,000 that you pay yourself every month, you'll be paying tax that is called payee on it. That is your own income. That's your own whatever that you are paying. You are paying payee every month of, let's say, 25% or whatever it is. You are paying payee every month from that income. But at the end of the month, they allow you to remove your salary, remove every other expenses, by the time you are done, maybe your profit is, if your profit is still 120, which I doubt to be, you'll now be paying 120 million of that. Another example that can really help you bring it home is, let's assume that in this case, your income is now, your business revenue at the end of the year is 100 million and all your expenses came to like 60 million and you have 40 million left. Because companies that don't make more than 100 million enjoy CIT free, you can get to keep all this profit that you have made. You keep it for yourself, for your business, right? You're not paying any tax. Whereas under personal income, under business name registration, even though you have made 100 million for the year and you remove all your expenses, the balance will be taxed and you have to pay personal income tax on the balance. What I'm just trying to explain is that your business income is seen as your income under business name registration, and all of it is taxed. Whereas under company, the company's income is different from your own personal income. So if your company income is not even up to 100 million in a year, you get to enjoy tax-free regime. Yeah. Another thing that LLC allows is what is called capital allowance. And I'm going to explain that capital allowance. Capital allowance means that in the course of the year, if you bought machinery for the business, let's say that I bought a new computer, a new laptop for my business, for my remote business, or I bought a generator. Anything I buy for that business, the law allows what is called capital allowance, but there is percentage for it. Let me see whether I think I made some notes. I made some notes on this capital allowance. I made some notes. Let me just go to the note that I made. Okay, so this is note on capital allowance, the eligibility. Assets must be used for the business purpose and not for personal use. Example, if you bought generator in a particular year, let's say you bought that generator 1 million, the law allows you to take out the money that you used to buy the generator from your profit before the balance is now taxed. But it is limited to 20%. The assumption is generator won't spoil in a single year. You cannot take out the whole money of that generator from you cannot enjoy tax freedom for the full value of the generator from that single year. So you can break down the cost into 5 years. So 20% of 1 million is 200K. You can take out 200K from your profit and tax the balance in year 1, 20% in year 2, 20% in year 3, like that. So it's called another one, written down allowance, which is what I've just explained right now. Most assets are deducted gradually over several years using prescribed percentages. What I've just explained right now is what accountants will call depreciation. So the asset that depreciates in value, you are now making provision for that asset. And to help you understand as a layman, if you bought an asset for your business, it's wise. Let's say I bought a car. I run a company and I bought a car for the business. You know that a car normally should be written off from the books of the company in 5 years. I want to start making provision for another car from the very first year that I buy that car. So if the cost of the car is 10 million, I would assume that every year 20% of that car is being used. It will be